is there any exciting news from anyone on the call so far about your business or things going on in your life? It's just a little bit of a time to share. Rick, I'm sure you have something to share. You just got back from New York.
Yes, where the displays in the Met were fabulous. So strongly encourage everybody, particularly now that some of the handcuffs are beginning to come off from the pandemic, that we get out and sort of get reconnected with the cultural side of our lives. I think most of us have been tied to Zoom and working on business stuff. So there's lots of interesting things going on in the world, and getting reacquainted with them should be high on everybody's list.
Yeah, that's so true. The museums and cultural venues have really been hit hard, and they're struggling to get back on their feet. We're very aware of that. So I wanted to share that we, CCE, celebrated our 10th anniversary on May 26th. Well, it was a kickoff. This year, 2021, the whole year is our 10th anniversary. And May 26th was our kickoff event at Footnote here in Winston-Salem. All Momentum members were invited, and it was great to see many of you there. At that event, we announced a challenge of $110,000. We have donors who have contributed 110 pledged, and now we are working on the match. So if you happen to see an email that Nicole has crafted in her beautiful design magic about joining the match for the CCE on our 10th anniversary, we'd appreciate your support. So thank you very much. And the way to do that is at ccetriad.com. And also I want to share that our Velocity Accelerator applications have recently closed. The program will run from July through October. This is an accelerator for creative businesses that we run annually. This will be our sixth accelerator. And our demo day will be on September 30th here in Winston-Salem at Winston Starts. And we will announce the awards and the winners of $50,000 in seed stage funding that will get split between 3 companies in the program. So CCE is very invested in creative businesses, and financial equity is so important to us. That is why we really wanted to dig into this topic today. But first, I wanted to just share a brief about Momentum. Momentum is a monthly gathering. We bring people together every month with curated content, meetings, and we actually have a directory. If you're a member, you're part of the directory, and it really helps improve your search engine optimization on Google. And we have opportunities to find out about jobs and all kinds of opportunities. So it's a really great gathering for inspiration and networking. That's what Momentum is all about. And if you, there is a small charge to be a member. You can see there on the screen. You can pay monthly or annually. It's not very much, but it helps drive the programming and drive the content and the costs for the program. So, and you'll hear about something new that our amazing marketing and events coordinator has dreamed up along with the staff. And I want to turn this over to Nicole Gentles, who is going to share with you our new summer series for CCE and Momentum.
Thank you so much, Margaret. So we have a new and exclusive summer series of events for members only. We are very appreciative of the support of members over the past year and more, and we want to give the love back and see our members' faces. And so we're excited to be putting somewhat of an end to virtual meetings and see you guys in person. If you are a member or joined before July 22nd, you're invited to our summer series. It'll be in Bailey South, and we're partnering with some organizations to do pizza and beer and games and music. So registration is required, and we're really excited to see everyone. We hope that you can make it in person in real life, and also save the date for our finale summer event, which we already know is going to be demo day, September 30th. We want to make sure that everyone is there, it's public, and you'll receive more details about that via email. So now, and I apologize really quickly, I'm letting people in still, so kind of the slides can be a little bit sporadic. I will also drop the link for registration in the chat for this event, but it is for members and their friends only. And then I'll introduce Rick. Any questions about momentum or?
Can we see a high five for summer in-person events?
a virtual high five.
Hey, jazz hands, come on, jazz hands. You got this.
All right, let's see. I'm going to pin you guys. Quick reminder before I introduce Rick, and as I pin our speakers, please ask your questions. Feel free to interrupt. I'm a big proponent of interrupting and making the conversation just flow really well. But if you want to just add your comments to the chat, your questions to the chat, we will make sure that they are fielded and asked. Okay, so we have our three gentlemen up there. And so I will introduce Rick. I'm very excited to introduce Rick Leander. He is our moderator and board member. He is a global executive with a track record for transforming the way businesses are run. He leverages his financial services acumen and entrepreneurial spirit, adding a bit of behavioral science to help companies reach greater heights. Like me, he loves exploring a problem and its potential solutions by facilitating difficult discussions, asking tough questions, and stress testing strategies. Rick works with an exclusive set of mission-driven CEOs, executives, and business founders, helping them shape and grow their companies. And we are so lucky to have him. Take it away, Rick.
Terrific, Nicole. Thank you very much. I'm really excited about the panel today. We've got two terrific panelists to talk about financial services and how technology is helping them attack markets that have traditionally been underserved or ignored. I'd like to do a quick introduction of the two panelists. First, Calvin Williams. Calvin I've known for a fairly long time and have watched the development of his process. Calvin is the first American owner-founder of an automated wealth management platform for retail customers. As CEO and founder of Freeman Capital, he aims to close the wealth gap in overlooked communities across the country through increasing access to financial planning, investment management, and financial education. As you're going to hear today, Calvin has been really, really busy. He's completed Google for Startups, the Black Founders Exchange, Atlanta's Ascend 2020 Accelerator, and Charlotte City Startup Lab programs, where the company won Best Technology Platform. Freeman Capital was invited to be one of 6 companies who won the NC Idea Seed Grant in 2018, as well as the first North Carolina crowdfunding grant by NC Idea in 2019. And he continues to, he and his company continue to receive awards every single day. So I know you're going to be thrilled to hear what he's been up to and what he's focusing on. I'd also like to introduce Joe Carroll with Bank OZK, the regional president for us here in the region. Joe's a seasoned senior business leader, experienced in bank operations, branch management, commercial and retail lending, and cash management. Over the years, Joe has excelled individually as well as a team to accomplish the right things. As a consultative advisor, there are times when meeting a client's needs goes beyond the product. At times, the real needs to be a good listener and use the benefit of experience to make them aware of the best practices or to help them make beneficial connections, as well as to keep them away from making the big mistakes that the rest of us have made. We're really thrilled to have Joe on the team as well. And now would be a really good time to thank Bank OZK in particular for their ongoing support of CCE and Momentum. So the format today is
Thank you, Joe. And I would like to add that he is a really good listener. You can talk to him about any of your financial issues and he always has an answer. He has a great answer.
Well, thank you. You're too kind. I appreciate that.
Terrific. Well, thanks. Well, so what we're going to do is I've got a few questions that we're going to use to kind of prime the pump for this conversation. But as Nicole mentioned, we really want this to be a dialogue with the participants. So as we go through this, if you've got questions or comments or want to raise an issue that we haven't gotten to, please either take yourself off mute and kind of interrupt us or raise your hand, and I'll make sure that we get to you. And Nicole will also keep an eye on the chat box to make sure that if somebody's got something in there that we don't miss it. So I'd like to start with a real simple question, I think, and we'll start with Calvin. Calvin, can you talk a little bit more about the target market for the work that you're doing and why that target market was so interesting to you? Sort of what drove your passion around dealing with that?
Yeah, and one, first and foremost, I'm grateful to be here, and I'm thankful to be on this panel. I'm excited to kind of talk and have this convo with Joe as well, and then as with the rest of you all. So, I mean, when I had exited my first startup and thought that I had made it to a certain degree, and I went to try and find a wealth manager, it was at that time that I realized that what was money to me and my family in my eyes was virtually nothing in their eyes. So there was like, hey, if you can't give me $1 million, there's really nothing for us to talk about. Politely, but that was the general message. And that is what triggered the thoughts around Freeman Capital. Like, how can we make the wealth building part be more accessible? Because in my perspective and my understanding, there's an inherent bias in wealth management. It is a service model built to help manage the downside risk of wealth that's already been developed. But the focus of Freeman Capital and the focus that I see that we need in America to help our middle class to grow and develop is help to build wealth. And so that's really what we're focused on at Freeman Capital, is providing those niche wealth journeys that would result in people's net worth increasing. And that is where I think the biggest opportunity lies. The wealth management industry is, it's been around for forever. But when you talk about wealth building, taking folk from one level to the next, that's really where I see the most help is needed.
Terrific. Thanks, Calvin. Joe, I know that in the conversations and interaction you and I have had, small businesses, people who are just trying to get started are a real passion of yours. Can you talk a little bit about sort of how you guys think about that and sort of what got you interested in that particular piece of the segment?
Yeah, in my career, I have served in a lot of different communities, from large communities like Winston-Salem to smaller communities in North Carolina, pretty much all here in the Piedmont Triad area. But there's a mystique, I think, about banks, and I think they may be afraid to come and talk to a banker because they just don't know what to say or don't know how that conversation needs to fall into place. And so, I want everybody to really understand that our bank and probably other banks as well, we're serious about having those conversations. We have a real responsibility in our community to make sure that we service the needs of everybody in the community. And for the small business person, it might be a startup, or it might be that small business that's really going to the next level. The biggest part of that conversation needs to have a plan in place. They really need to be thinking out exactly what they want to do, how they want to accomplish it, what does their budget look like, what does their marketing plan look like. So for me, and probably for other bankers, there's a lot of satisfaction in actually talking to those people and seeing something grow. I was looking at a company this morning, they just finished 2020 a little bit down, but they were a $5 million sales company and had a nice bottom line, and the officers took out some decent salaries. But those guys started probably 20 years ago in a garage, and they had the right plan in place, and they executed on it, and they had I think a good banker in place to help them get access to what they need in terms of credit. So those folks just don't need to be shy about coming to the banks. Use us. We're a resource, and we can help them connect some of the dots. We can help them get connected with folks who can help them develop their business plan and start off the, that next step where they, can come in and get access to the credit they need to launch the business. So that's where that we just think it's a real responsibility for us in our community to make sure that we help those people get done what they need to have done.
So Joe, continuing to build on that concept, right? One of the things that we've been exploring in these sessions with Momentum is the mashup between sort of various aspects. So much traditionally of banking, particularly community banking and small banking, has been built on those kind of personal relationships. How has technology changed the way you're able to interact with those segments, or has it changed it at all?
Well, yeah, I think it has. Just the credit process. It's very technologically advanced now, where everybody has credit scores. So the credit scores are good predictors for us in terms of how they're going to repay that loan. It shows that they have the character, and character is a big thing in credit, and you assess that character by developing that relationship. So those are some of the big things in credit. And, now we have models where we can actually, put together financial projections and show, what it would take for the company to, or the business to actually be able to meet the debt service on those credits that we do. But from the other standpoint, on the product set, with people getting money into the bank, we've got all kinds of different technology. My light just went out there. Anyway, we got all kinds of technology in place to help them. They can bank from their car. They can bank from their home, from their office. Make deposits, scan checks to us. It goes into their checking account. There's different types of ways to collect money, whether it's through taking credit cards, debit cards with merchant services. We have platforms for that. So, we've actually given them the keys to the branch bank in their living room and their computer to be able to do just about anything that they want to do at home that they could do at a teller window at the bank.
Terrific, thanks. Calvin, it is, with my experience over the sort of the years, one of our constant concerns about serving what were often underserved or under-focused on clients was this notion that the implementation and attraction and support costs were just too expensive to deal with those people. For instance, in your case, the folks with less than $1 million. So how is the technology evolved in a way that allows you to go deal with those segments that traditionally got ignored because they weren't big enough?
Yeah, and I also want to define a couple of the terms so that everyone's on the same page, because often when people hear terms like underserved or underbanked, there's a perception of what that means. And I think it's important that we all have a very clear understanding, so we all, at least in this conversation, have the same meaning of the words. To me, a customer that is underserved is someone who has the means, making 50 to 200K, and they are not being, and their needs aren't being served by their banking institutions. Underbanked are people who are on the lower income level, and they literally do not have a banking system that they are using. And unfortunately, I deal in the harsh realities of this country, because I believe that through technology, through will, we can start to deal with some of these problems. But the underserved problem is one of the largest problems that we hope to solve through technology. There are numerous stories of people of color who can have high incomes, have high credit scores, and still be denied at an overwhelming majority, much higher rates of denial for lending products. And so, as we are building out our suite of products and servicing this group, it is important that the models that are being provided that help to make the decisions, that bias is unremoved from those models. because it's been proven several times with AI, and I myself am very intimate with this knowledge. I mean, I was recruited at 17 by the Department of Defense to build top secret computer programs and skipped the first 2 years of my college degree in comp sci. So I know AI and comp sci very well. And to really solve these societal problems, they have to be designed with diversity in mind. And the way that technology can enable that is it can be an equalizer of opportunity when that is designed. But it has to be purposefully done. And if it's not purposefully done, then we will end up with a very fast denial process instead of a very long one.
Yeah. There's been some interesting articles this last year or so about how this notion that algorithms are picking up the biases of the people that are programming them. And so we're simply kind of institutionalizing another layer of issues with some of these tools that we're using. What other, so I think those definitions and really help the conversation. Can you perhaps talk a little bit more about how perhaps the democratization of some of these tools is going to allow you to get to markets that for a variety of reasons may have been ignored?
Yeah, so to me, there's two levels of democratization. There is the actual technical implementation of democratization, which is what happened with the first wave of financial technology products, which opened up the door for people to use them. Wonderful apps like Betterment or Robinhood, they have some challenges, of course, on the Robinhood side, but these types of applications that made it easy to do a transaction. Because really, when you think about how most of the fintechs and how VC is training sort of to think, it's let's solve a niche problem and then you can grow and scale and sell. And so as a result, we are being trained from a startup perspective is that what problem set can be made more efficient? That's where cryptocurrency was initially started in terms of payment processing. That's where we have asset management wealth and these fintech tools, but that's just the first layer of making it accessible. Then the second layer is making it inclusive, because it doesn't matter if it's accessible but not inclusive. That's just like in prior years, you can walk into a bank, a JP Morgan, what have you, and if you aren't treated like they want you there, then you're going to leave. So it's a two layers of progress that we have to go through. There's a technical layer that has and is going on. And now there's an inclusivity layer that is going on, which, to be very clear, this is not about community service. The majority of this country is going to be a person of color in the next 50 years. And so if we want to serve the largest demographic and reach the middle class, we have to build products that are going to be inclusive, not for community service needs, but for economic needs. And then that's how companies can maximize shareholder value by thinking of the second wave of accessibility, which is around being inclusive.
Got it. Joe, it strikes me, at least in the institutions I've worked for, that as we talked a little bit before, institutions really had trouble trying to get their heads wrapped around how to deal with people or deal with companies, particularly early stage companies that didn't have much of a track record. Can you talk a little bit more, not just about how some of the technology has allowed us to change the way we made decisions and analyze risk for those segments, but perhaps a little deeper understanding of whether or not those technologies have allowed you at a lower sort of cost point to deal with people that you might otherwise not have been able to deal with at the startup stage?
Well, yeah, I think for banks like ours, and we're a large bank, we're a $29 billion company, but one of the things I like about our company is we're set up in different segments in the company. I'm part of the community commercial banking group, so we still think it's important to sit down face to face with those people and talk with them, and this whole thing about disparate treatment. I mean, we certainly we train our folks just every year on the different regulations that we have to abide by to make sure that nobody is left behind in that process. And the thing about that is when somebody comes in with that great idea, it's good they've got that idea, but we really need to work with them and really understand why that idea makes sense, what they have done with their homework to develop that plan to make sure they can carry out that to carry out exactly what it is they need to get done to make that business successful. So there are a lot of different things that we probably would do. Either, we may not be able to have them bankable at that time, but we can send them to folks like CCE. We can send them to some of the small business technology development assistance centers. We can send them to our group internally. We've got a government guaranteed lending program, which primarily does SBA loans. And there are a lot of good startup products there they're quick, they're convenient. They don't require all of the level of scrutiny and underwriting that we have to perform for some of our other businesses. So all those things are at our disposal. But I guess the thing I want everybody to understand is that, please have the conversation with us. Don't forget about us or your bank or whoever you deal with on the financial institution side, because all these banks here, they really do. They want to make sure that those community services are provided, and we're doing the right things to help whatever they're underserved or underbanked. We've got the products in place. We developed a mortgage loan program for people who are probably on the lower income spectrum. We'll do 100% financing for loans that are in the lower income areas. And that's just another sign that our bank and maybe other banks, want to ensure that we're doing everything we can to make sure everybody in the community has access to credit. So I don't know if that's a answer your question as far as technology, but it still starts with the personal relationship, and I don't see us getting away from that anytime soon.
Terrific. So, one of the interesting things that a lot of organizations, particularly emerging organizations, are doing is taking a look at the current data processes and the way we think about things and the way we've typically analyzed things. And they're trying to figure out different ways to do that stuff. And Todd just asked an interesting question in the chat. Todd, what I'd like you to do is, could you come off mute and ask your question? And Calvin, I'll ask you to take a first shot at it and then turn it over to Joe.
Sure. Thanks for the stage. I wasn't expecting that, but yeah. So I guess for context, I came from financial services in an unrelated kind of segment, but I'm now working in kind of exploring new ideas around financial services and how we can really work to counteract some of the dynamics that are currently existing that is essentially entrench economic inequality. One of those dynamics and models that currently exist that I think play a role in entrenching economic inequality is the credit scoring system, where I think it was previously discussed a few minutes ago how it really is a snapshot of your current economic state, but in an unequal kind of economy that only recognize kind of current wealth. And if we're really trying to address economic disparity, I think the new model has to incorporate other measures, other parameters that aren't so as objective. And so I guess my question is really open-ended, is what could be the new approach? What could be the new model? What data do we look at to really support and lift up the underserved in a system where the current model is inadequate in assessing a full kind of holistic measure of economic potential and economic status?
Yeah, so it's really interesting that you mentioned that because we're actually working on a model like this now. I actually think that the opportunity that we have is that with financial technology and how it can remove some of the friction and cost that goes into providing these services, that we can look at doing different types of business models to make things more accessible. So just for example, then I'll go right back into your question. But I think that there's an opportunity for us to mash up different types of industry best practices to create something new. I mean, when you look at financial planning historically, just as an example, that is traditionally done either as a percentage of AUM or as a high dollar cost per hour, like $200-300 an hour, right? But with technology, you can strip out some of that human labor to decrease the cost to serve, and then you can wrap that in a subscription model that is digestible for folks to pay for the price of Netflix, like what we're doing. So I think that the opportunity here is as we deconstruct what is the goal of these numbers that we're looking at in terms of credit scoring in particular, the goal is there to measure risk and how likely or could a person pay it back. And so then the question is, and I'm not going to go into full detail because we haven't released it yet, but then like the question is, what other measures would determine if a person is reliable and able to pay? We see it now where we have services who are bypassing the credit score system and looking at the direct banking deposits and withdrawals and transactions that you're doing, measuring your cash flow over time, because that's another measure of your ability to pay. Like there are some people who unfortunately game the credit system and still can't pay things because their cash flow is slow. So I think that with the open data that we're beginning to get around people's personal finances, and then the way that we can look at algorithmic trends of how people like them have paid back or not paid back, a door is opening to where, FICO and such are going to have an opportunity to determine if they want to be a bit more inclusive. But the interesting thing is that because this is a multi-sided market, that you also would have to remove the entrenchment of everyone who uses FICO. And that's a massive friction to overcome as well. So even if a better model did work, then the next question that I would have is, how are we possibly going to get traditional banking to move off of the FICO because they can trust it and know that it works into something new? And that's probably the biggest hurdle. Like all of these startups, is the psychological hurdle to get someone to overcome.
Calvin, you mentioned AUM is one of the ways that people get compensated. Would you explain that real quickly? There may be some who don't know.
Forgive me for that. And I thank you for that call out. So traditionally in the wealth management industry, it's about assets under management. So if you have $1 million and they have a percentage model, it could be like a 1% model. But they're going to charge you $1,000. Is that math right? I think it is. Someone help me out. Is that wrong? I see head shaking. All right, we're just going to assume that's right, okay? Because none of us know, right? So we're all on the same page. Way to go. But I thank you for not leaving me hanging. But yeah, so the AUM model is a percentage of assets managed. So if it's $1 million, then the asset manager would make 1% of that every single year. The problem with that model is that it only incentivizes you to serve people who have assets. If the average person in the US has savings of $400 and you get 1% of their assets, there's no model in which you're going to make your money. And so as such, you have to do a mashup of looking at a different type of way of generating revenue and still providing the service.
Thanks, Calvin. Joe, you talked a little bit earlier about sort of the desire to actually sit in front of people and sort of look them in the eye. Is that one of the ways that you guys are sort of not as strictly tied to sort of the traditional sort of monitors and measuring tools that other larger institutions like the super large may be playing with in these segments?
Yeah, I think so, Rick. I think that the models, the credit scoring models, they are indicators. I mean, and for the most part, they are fairly accurate. Somebody's got a high score, and they've shown that they've managed and controlled their credit. That works. If somebody's got a very low score and they've got a lot of charged off debt where they've not paid it, then that score comes into play there. But I think from our standpoint too, we're a bank, obviously, so the money that we are loaning is the people who put their paychecks in here every week, or they've got their life savings in here, and we've got a fiduciary responsibility to take care of that money and make sure that we're extending their money as that they deposit out as loans. That credit, it needs to be done in a manner where we're reasonably sure that we're going to get paid back on that money and return it to them at the end of the day. But I was looking at a loan this morning for one of our lenders, and the borrower's credit was good, but the credit score was not. It was below what our minimum standard was to make the loan. And we looked at it, and there was nothing in there that showed that he wasn't paying, and he didn't have an excessive amount of credit. He had some issues probably 7 or 8 years ago, but in the last 7 or 8 years since that happened, he's proved himself. So that becomes what we call an exception on our end. We're going to extend the loan to this person, and we're just do a little mitigation and put a statement there. Here's the reason why we're going to do this credit. He's got a good business. He makes good money. He's got good assets in terms of money in the bank, liquidity, and those types of things. So yeah, I mean, in a bank our size and probably smaller banks, the conversation is important because the numbers may not tell the real story. So we've got to look into the numbers, look under the hood, and just determine exactly why is that score not acceptable. And if it's they just historically just don't pay their bills, then that may be why, but sometimes that's just not the case. So
in general, go ahead. Somebody. In general, financial services is a highly regulated industry. Joe, I'd like to start with you. How are there examples of things that either your institution in general, or you specifically, or the industry in general would like to be doing that you think would be more effective for these segments, but you're hamstrung because of the regulatory environment that we're operating in?
Yeah, I mean, we can only do certain things because of regulations. And, if you do something like Calvin was talking about, if you do something for somebody that maybe you wouldn't do for somebody else, and they may have the same similar circumstances, well, you've mistreated someone there. So we've got to be very careful and walk that fine line to ensure that we're extending credit to everybody that truly deserves that credit. And it'd be nice, and we do this with the mortgage program I was telling you about. We set aside money in the company that we're going to make it to people who have they're from low income means, or their credit, they may have some blemishes and some issues there, but we're going to take a chance on some of those folks just because they need to get into a home and start making their way back. So if we can do things like that and escape some of the regulatory scrutiny, that would be great. But at the end of the day, we still have to be prudent with what we're doing with the depositors' money here at the bank.
Got it. Calvin, what about you? If you could wave a magic wand and change one regulatory handcuff that you're living with today, is there an obvious choice?
One regulatory handcuff. I think that the one that I would probably change, because they are needed. Like, let's take a big step back and say that, the purpose of these regulations are to protect consumers. The one that I would modify would be the definition of a accredited investor. I think that the accredited investor definition is, and this is not my term. Someone else said it, is a version of startup redlining. Because for those who don't know, a startup cannot raise more than money from more than 34 people who are unaccredited investors who make less than 250K in annual income or have less than $1 million net worth, excluding their home. But if you are a startup and you are raising from accredited investors, there's an unlimited number of people that you can raise money from. So when you talk about and for every logical reason that Joe just said, banks cannot take the risk of being super duper early stage. It's just extremely risky. That's why you have like VC in that space. But the problem is that companies require capital, and for myself, I had to raise multiple friends and family rounds because my average check size was $11,000. I did not have an accredited investor who could give me hundreds of thousands of dollars to help me grow my business. It took me 3 years to raise $800,000. And there are some folk with the accredited investor network who can do that in a week or a month. And so changing that definition would help to balance the scale to give founders who did not come from a place of privilege of network and opportunity to be able to raise funding from their friends and family to launch their businesses. And then that would help more of these businesses grow and develop to meet these very high marks that other people have to adhere to. So if we're going to talk about solving from a business perspective, how to help more of these underserved founders grow and develop. And mind you, I came from a 6-figure salary. I was a director at Lincoln Financial, and I still had a problem, So I'm not like, just because there's a perception of like what this person can look like, and I was that person. And so redefining what is an accredited investor or removing that rule would open up the opportunity for people who don't have a network of rich people to back them to help them grow and build their business.
Or the information either. And I have a question, raised hand from Susan.
Yeah.
Go ahead, Susan.
Thank you. I'm just wondering, as entrepreneurs, they're constantly looking for capital. But what about employee company? Instead of necessarily looking for venture capital somewhere else, working with your team for equity within the company, do you have any experience with that? And then how does that work with finance as far as how do you apply for a loan? How do you build the business financially if you have an employee-owned company?
Forgive me, was the lag on my end? Because I feel like I missed key questions that she. It was like key question. I missed that part.
Yeah, sorry, Susan. You got to start from the beginning. We missed the beginning of your question.
Is this any better?
Yeah,
we can hear you for the most part, I think. Yeah.
Okay, I'm sorry. So I'm wondering about employee-owned companies versus where a traditional entrepreneur might have investors and venture capital for equity. Mm-hmm. For those companies that may have employees that are part of the business and have equity in the business, how does that work for finance and loans within that company? Do you have any experience?
Is that to me or to Joe?
Calvin, you can start, and then we'll move it to Joe if he has anything to add.
Yeah, so I've ran a couple of, I have an employee-owned business now, and I had one prior. I have raised money from friends and family, grants, SBA loans, microloans, and now VCs as well. I think that the way that the markets are set up is that there are hurdles that are so high that have to be cleared because returns have to be not guaranteed but assured. And so regardless of the type of entity that it is, employee owned or VC backed or whatever, the the true measure is always going to be in the math. And so for employee-owned businesses, I've not seen specific programs for that, except just as FYI, the American Rescue Plan Act, the one that Biden team just passed a few months back, they have a $10 billion program, which they're like, people are lobbying that these funds go to employee-owned businesses like what you're speaking to, because there is a gap in that as well. But I mean, for a business in that type of a structure, I would probably look at, of course, the traditional banks. Joe can speak to that better than I can, but probably the new sector of revenue-based lenders might be able to serve you. So, you know, there are platforms like Lighter Capital and others to where their lending is based only on what your revenue is. And so it depends on what sector of the market that you are in, like if you're SaaS-based or whatever, but like they will lend you a multiple of your revenue. So if you're making 10 grand a month, they might lend you 1.5 your revenue multiple, and then take 8 to 12% of that in interest every month. And so like there's like this whole new crop of lending that's going out there, which is like bypassing everything except for what matters the most. What is the revenue? And so for a employee-based business that's having, you know, problems in other sectors, I might look at those types of revenue-based lenders, and you just Google that term. There's a whole crop of these folks coming up that can help you grow and scale.
Joe, any thoughts about this area?
So Susan, are you talking about like, I don't know how large a company that, as far as the employee numbers is, I mean, is it small? Is it 50, 100, or I'm just trying to.
I'm sorry, fewer than 50.
Yeah. I've not had any experience with an employee-owned company like that, but you know, we do deal with a lot of smaller companies where there might be 5 or 6 family members, and they all own the business collectively and individually. And you know, in my experience with those, it is really, I guess, it's sort of spread the risk out, you know, among multiple people, because they all have different personal situations. They have different sets of personal assets and things like that. They're all taking money out of the company as well. And you know, from a business credit standpoint, it's particularly with a small business, we're always, you know, looking at that level of who the owners are, and you know, if the business doesn't perform, then are those owners going to, you know, pick it up and get it home because they can. So that would be, you know, a personal guarantee on their part. If the business doesn't pay, then, you know, we would look to them to pay. So I'm not sure that's answering your question exactly, but I just have not had any experience with a true employee-owned business before.
Thank you.
As I think Margaret put in the chat, you know, startups in general fall into that category of under or unbanked, and startups in the creative space probably even more so. I will say a couple of things. For those of you who have some connection to Winston Starts, Bruce Maxwell did a really interesting talk yesterday or the day before about bootstrapping. And some ways to think about generating working capital through sort of channels that may not be traditional. So it might be worth either tracking that down specifically or just having a conversation with Bruce about that. Also, it turns out that we've got Anthony on the attendee list today. Anthony, have you got anything you'd like to add about this issue around funding for early stage startups?
I don't necessarily have a question about that. I had a question I was kind of rolling around in my head, and it more had to do with how can we ensure that we can use financial services to close the wealth gap for specifically Black families and Black households. And what was rolling through my mind as I was listening to the conversation was, I was thinking about some of the predatory financial services that have been provided in the past, even like till today, For instance, in Detroit, folks who want to quote unquote own a home and can't get a mortgage, they get what's called a sales contract. And basically an investor will give them a contract and end up paying twice the amount of what the house is worth, and they never end up actually owning the house. And this is a practice that has been done for a while. So I'm just thinking about what are some creative ways to kind of fix the damage that has been done specifically to the Black community when it comes to financial services. So I don't even, again, that's a heavy question, and we got 4 minutes. So it was just rolling around in my head though as we were having the conversation.
Who'd like to attack that first?
Yeah, I think home ownership is certainly a way that anyone, it's how you build your wealth. It's your largest personal asset that you're going to purchase in your lifetime. And if you get the loan and you pay it down, then and the value of the property is appreciating. Yeah, it's a true wealth builder. And I think for some of these, Anthony, some of these underserved markets, like maybe what you're talking about, I mentioned our bank, it has the Freedom Mortgage Loan, and it's designed to work with those folks that may not have a down payment or may have just a small amount to put down. Their credit scores can be in the 600 range to kind of help them get back on their feet. So that's one way that we're trying that. We're trying to push that out as much as we can, and we've got a lot of folks who are taking advantage of that program. So I think that's one way that our bank and probably other banks have a similar product that they're working on to make sure that some of those the communities where you have African American or low income or whatever the demographics are, to make sure they have a chance at having a fair loan. I mean, these loans that we're making 100% financing, they're 30-year fixed rates. They're 4.25% at this time. Yeah, you can see other mortgage loans that are in the 2.5% to 3% on a 15-year loan. But this is a different animal. But if somebody's renting a house for $600 a month, they could buy that same house and pay $300 a month with this type of loan. So I think that's one way we're trying to be responsible and attack the community and try to help those people become homeowners and help them on their track to build wealth. So that's how we're doing that, I think.
Yeah, I mean, that's a really big question. I mean, we are of course trying to do our part to do that, but like here is the bigger point that I would like to rather say, because I think that when we pigeonhole it into helping a Black folk thing, that and I'm not saying that we shouldn't. I mean, obviously, but that can trigger certain adverse reactions to where people resist it. And the way that I would like us to reposition this conversation is we need to help the demographic that's the farthest behind with the highest income growth currently per percentage, because when we can help that demographic, it's going to trickle down to the other communities that are there, because there are white folk who are behind, there are Asians who are behind. And so specifically designing programs that do the work to help the group that's the farthest behind, which happens to be Black people, then there will be lessons learned that can be applied to other communities and help them grow as well. And so it's many ways like the way that I think about rap music. Rap music was created for and by Black people, and now 60% of it is bought by white people. It's just how it is, right? So in building something that is tailored to the demographic that's the farthest behind, and then specifically helping them, there will then be tangential benefits on how to replicate that throughout the rest of this country. But the one point that I want to make back to Rick's comment, because bootstrapping is a big deal, especially in the Black community, and just unfortunately. So I mean, when I was at Lincoln, I had to bootstrap Freeman Capital on my own. I mean, I took half of my salary every single month and I put it into my business for 3 years. And so I know how hard bootstrapping is. It is unfortunately the easiest way to kind of get it up and going, because all of the risk is on you. And really, I encourage folks to bootstrap as much as you can, because it, one, gives you a ownership position, and two, it might be the only choice that you have, unfortunately. But it will make you a better business person when you get through that stage. And so, yeah, that, I just wanted to go back and make that one comment. You know, I don't think there is an incentive economically for the country to change and help just Black people, because we have our country is driven by capitalism. And so to make these change happen, we have to find ways to make it a financial incentive to do social good. And that's what we're trying to do at Freedman Capital. As long as the conversation is handed, or at least I feel like discussed in a way that looks like community service, it will never take off. But when we show the true economic incentive of doing good, that's how things can help out.
Very nice. All right. So seeing no other questions, we'll continue with my list. And Calvin, I'll start with you. In any time we're trying to introduce financial services to a segment of the population that has been underbanked or unbanked, there's both kind of there's a product mix to that, and there's also an education and training piece of that. Yep. When you think about particularly the area that you're focusing on, what does that split feel like? And are you trying to do most of both of those pieces in-house? Are you partnering with others? I mean, where are you spending your time focusing?
Yeah, so I think that, and I want to restate it. So there was a product focus, and then there was a second focus. Well, was it
education, the literacy, financial literacy piece.
Perfect, thank you. I actually think that if I had to split my time, it's probably 70-30 around financial literacy. And there is a literacy gap that is massive with every industry. Like I was talking, I was on a panel just 2 days ago, and I was talking about the founder literacy gap. Like there's the building a business, which is like 30%, but then there's the literacy on how do I position my business in the mind of an investor to understand what we're doing so that they can back me. And so the gaps are the biggest problem to solve. When you know what to do, or can figure out a product, or can customize it, that's the biggest part. That's why we conducted one of, if not the largest, Black millennial wealth studies in the nation, surveying 4,000 people, because we need to understand what were not just the socio and economic challenges, but the psychological challenges that were inhibiting people from growing and building wealth. I mean, truly, at the end of all of this, thanks to Google and, back in the day, because I'm gonna date myself, freaking Alta Vista, like search engines are making information accessible. But what is not changing is the behavior science in our brains. And so really what we're talking about doing is changing the behavior of the consumers and of the folks who have the decision-making power over the products. That is all that we're talking. This whole conversation, and my eyes, comes down to that. Is what are the thoughts that have become behavior, that have become characters of the consumer and of the industry, and changing those two things is how we make a change within our country.
Perfect. Joe, what are you guys doing as it relates to this sort of educating part of the equation?
Yeah, so Joey Ellington is on the phone, and we actually is part of our community development group. So one thing that they are charged with is helping the folks in the field, our employees, to have access to various education modules. It might be, working with a small business, talking about, what they need to do to get access to capital, helping them write their business plan, or working with an individual, what they need to do to build their credit, just a gambit of different things. So all of our employees have access to that. We have actually loaded up that wagon, taken it on the road, and gone into employers and other small groups and conducted those courses. It's something we want to do. We feel like it's good information, and it just gives everybody the best opportunity to get on the right financial pages. So so education, it's it's key. It really is. It makes better citizens. It makes better lending customers, better banking customers. So we're totally all about that, and we continue to work on that and try to modify it and bring as much as we can to the education portion of that group.
Terrific. And I'm going to I had promised Nicole and Margaret I wouldn't do this, but I am going to editorialize just a hint here, which is one of the things that I liked about both what Joe and Calvin said was this education sort of mashed up with sort of real deliverables and real products and real support. As a behavioral economist, we know that knowing stuff alone does not change anything, right? And if you want proof of that, take a look at the health of this country, right? There aren't very many people in this country who don't know that they ought to eat less and exercise more, and they know that, and yet they don't do it anyway. And they don't do it because we don't provide them with the tools. We don't provide them with the context. We don't provide them with an environment that makes those smart decisions smarter to do. And financial services exactly the same way. We're asking people oftentimes to make sacrifices in the short term so that in 30 years they can retire, or so that they can put their kids through college. Those are, from a behavioral economics perspective, really difficult things to do. So I really applaud the work that you guys are doing in terms of, yeah, we're going to educate people, but there are tools that we have to put in place with them to make these actions that we need them to follow much better. So well done. And I'm off my soapbox on that one. So what other questions?
One question from
Please, go ahead.
Margaret, if you want to ask your question, Margaret.
Well, I think Rick kind of mentioned it. I wanted to just chime in here that, Center for Creative Economy, that's what we do, is we educate founders and entrepreneurs about how to build businesses. So, and this whole Momentum panel, the Momentum series is, we curate people that can help, provide that. So yes, I definitely believe in that. But what I was wanting to just point out is that creative industries are also underserved markets. I mean, when I had the talk with Calvin before, that's like he was talking about the underserved, the people of color. I was like, well, just put the creative industries in there, because they are smaller businesses. They are usually bootstrapping and don't have a whole lot of income at the beginning, and it's just really, really hard. So, my question, which is, how can we help them access financial markets and get the credit or funding they need? And I just wanted to kind of make sure we were just addressing creative industries as well as just as part of the whole underserved.
Yeah, and I would not dare call myself a creative, because I'm not good enough to do that. But like back when we used to build websites and web apps and things like that, like we were being a version of creative, but nothing like what probably your folks are really doing. I would say that the biggest thing is the way that I okay, I thought I saw some jump in. For me, in terms of the creative, it still has to be firmly rooted in a really good business model. Because right now, folks will invest in business models if they are creative, and I actually think that there's an opportunity in diversifying the creative operation models through business models that have been adopted in different segments. And so I think that there is a major chance for creatives to be more of that on the business side as well. So it's one thing to be it with your actual service, which is needed, but then it's another thing to kind of push to figure out how to make it as uniquely workable on the back end. I mean, for myself, with my first business, we just had to be extremely frugal and really use the revenues of every sale to put it back into the business. It's a harsh reality, but it's the only way that I know, because the problem is that the way I understand is that lenders want to see a pattern lenders and investors want to mitigate their risk. And the way to do that is to show some resilience of how we're going to pay them back. And the problem with just the creative that I have interacted with, which is a very small sample size, is that the service they're doing is creative, but the business model is non-existent. And then that leads to no one being able to back them. So the same thought that is needed to make some creative, amazing, talented thing that I can't even think of, it also has to be done on the business model with some points of traction that would show that if someone were to put in money, they would get it out on the back end as well.
Can I share something?
Please, Joy.
Okay, and thank you, Joe, for mentioning me. There's a couple of things that's been said, and one, Rick, you brought it up, and that is about the behavioral economics. And behavioral economics, when you start talking about the different demographics of the underserved, there is a relationship or lack of relationship with money. It's not really talked about. And because of that, it is very difficult to make that transition of understanding wealth, how to build wealth, how to approach a banker, how to engage with technology. Because even when you talk about, you mentioned it earlier, and you were talking about, what is that? Oh, that platform where they were doing all of the acceleration with GameStop. Robinhood.
Yeah.
People playing around with Robinhood. And there are many people who will jump on a bandwagon because they hear that there's money there, but they still don't have a proper relationship and understanding of money. That's where the education comes in. I'm seeing all of that to circle back around because there's something I've been rolling out in some of the small business centers, and that's called Ask the Banker. And the reason why we're engaging with Ask the Banker is to try to close that gap on the educational piece, but also being present in an area where we're normally not there. So that's just putting some other things out there, as well as working along with Center for Creative Economy, because we do mentoring there too. So
they do, and they're very good. We really appreciate your support in our mentoring, and building those business models is key. We work on business models for the whole 10 weeks, but there's like 2 weeks of sincere, really devoted time when we focus in on it. And they have to get by Rick Leander before they can do their pitch.
Ayala, do you have a comment or a question? Okay, perhaps not. What I was going to say is, Calvin, while your business may not fall in the creative economy space as defined by the government, I think founders in general are creative by nature, right? You're creating something from scratch. So, and I will tell you that I had a hard time coming to grips with that myself, but having known you for a while, I would be the first one to argue you are very creative. So just want to put that on the table. So any other questions or thoughts before we turn this back over to Nicole? Well, I want to thank Joe and Calvin for their time this afternoon. I've seen some comments in the chat. Nice work, really informative stuff. You and your organizations are doing really good critical work in segments of the population that really need it. So on behalf of certainly CCE, I'd like to thank you for spending time with us today. It's been really useful and valuable and informative. So thank you.
Thank you.
So I'm going to just jump in. We were going to get a photo of everybody on the screen.
I took a screenshot about halfway through, but
Okay,
I think we had about 5 people leave already. So right now, yeah, I think we're good.
Good. All right, you're on it. All right, good. Well,
And I really appreciate you both. I really like what you said, Calvin, about restructuring from the bottom up and modeling financial services around inclusivity and not as like an afterthought. And I think that that's really where the key is. But yeah, so I appreciate you both, and I'm so glad that you all came out. I'm gonna reshare my screen and we'll get back to the slide deck.
thank you so much. This has been a fantastic panel. I've already sent it to a couple of people saying, you've got to watch this. It's really, really good. We'll post this on our YouTube channel, and we'll be giving you some after love. We'll be posting this and sharing it because it's truly a wonderful conversation. So yeah, thank you for being part of this. And we just want to remind you that yes, we're open for membership. So you can be anywhere in the country, Boulder, Colorado, you can still be a member. We'd love to have you. We do this once a month.
Yep.
And the next month, Nicole mentioned that we do have our members only series. This will be in person, pizza and beer in the Incendiary Brewery space, July 22nd. So you'll be hearing lots more about this if you're connected with us and on our social media channels. So
Yes,
watch your emails, please join us on LinkedIn, Facebook, and Instagram. And I think we have those handles somewhere coming up. But yeah, so thank you. Bank OZK is a wonderful sponsor of Momentum. We really appreciate it. We could not do this without your incredible support. We really, really appreciate you. So we're moving forward. This is our 10th anniversary year. We're going to be on the lookout for exciting things happening from the CCE, and we're going to be gathering and having a big party in the fall.
Thank
So,
you.
And
Thank you,
we'll,
Forsyth
and
County
we'll,
as well for being a sponsor.
yep. And we'll wish Calvin good luck on his 2 demos this afternoon.
Yes, good luck, Calvin, and thank
good
you
luck,
for coming.
Calvin.
Thank you very much.
Good luck. Yeah.
Thanks, everyone. Really enjoyed it. Take care.
Thank you,
Thanks,
guys.
everyone.
Bye. Follow us
Bye-bye.
on social.